Hey everyone, we're starting a new segment now where at the end of every day, I'm going to try to go over the biggest gainer and the biggest loser by percentage on the S&P 500. Not the entire stock market, just the S&P 500. If you go to MarketWatch on the computer and you sit there and see right here at the top, S&P 500 movers, it'll always show you the top one. That's a percentage gain and the biggest loser right there. So today, it's Nielsen Holdings and Qorvo. I have no idea what's going on with these. I'm literally going to do the 8 pillars from beginning to end. I'm looking at the companies initially right now. So I go to my Y charts. Now remember everyone, we're going to have this available on the Everything Money website and app at some point here. But I want to do this right here quick. So as you guys can tell, this company is down quite a bit. A previous high, it hasn't even been public that long. It hit a high 56 in July of 16, but a month after the Cavs won their 3-1 championship. Went public in 2011 at around $25 a share. So it's down from its IPO. So this is a $6.8 billion company. Now, the question is, what do they do? Oh, it's Nielsen ratings, I think. There you go. Nielsen Global Media Services serves media and advertising industries by providing data. So why are they up so much today? Nielsen up 7.8% as Investor Day lays out path forward. 2020 outlook looks good. Okay, so I guess they had some good outlook, and that's why they're up 1 billion% today. They're actually up 9.25% today. So the market cap is 6.8 billion. Remember, I don't look at stock price, I look at market cap. That is the stock price times all the shares outstanding. If you wanted to buy the company in full, you'd look at that number, not the share price. Two companies can have the exact same share price, but a totally different value. So get yourself trained and not look at the share price. PE ratio. Now this says right here it's a negative. And if we look in the last 12 months, they've lost $150 million. Do I like that? No. Does that mean it's an automatic, don't look at the stock? No. They could have just, especially with the recent events with COVID and the economy, this could be something completely different, a complete anomaly. So we're going to keep looking at it. Gross profit, 58%. That's a huge number. It's something I'd expect from a data company. So I like a high gross profit. Gross profit means what do they make for every extra dollar they sell today? So every extra dollar they sell today, they're gonna make 57 cents. Now, their profit margin the last quarter is about 0.5%. That means in the last quarter, their bottom line after all expenses, all taxes, everything is 0.5%. So probably something happened that in the last year, they're losing 150, but in the last quarter, they made money. They do pay a small dividend, 1.37%. Right now, that's about a little over $100 million a year because you take the market cap by the dividend yield, and that's what tells you how much they pay in dividends per year. So that's going to be important when we look at the free cash flow. We want to make sure we see sufficient free cash flow to support this number. Now, it looks like they're increasing their dividend here because this is the current dividend yield. This is the one going forward. So far, we have PE, which doesn't exist, so that's an X, and we have the profit margin, which is negative or 0.5%, so it's another X. So let's go to the financial statements and see what's going on. These are the last 5 years of financials. Revenue growth is the third pillar. We have 6.172 to 6.5. So it's increasing over the last 5 years, so that's a check mark still technically, but in the last few years it's actually down a little bit. So we have to figure out why that is. Let's see how it's done the last 12 months. The last 12 months, it's done 6.3 billion. So it's still down. So this is a company that looks like the revenue is going down right now. They are struggling to get revenue. That's probably why the stock is up so much, because they probably guided pretty well to say, hey, here's our new plan. So far we have 2 X's and a check mark. Next one is net income. Geez, oh, Pete. All right, last 5 years, it's an X here. They made 570 million, and now they lost 415 million. So now the good news is in the last 12 months, if you remember before, they'd only lost 150 million. So it looks like things are turning around, which is good. So still an X here because they went from profit to a loss, but they might be on that turnaround. Number of shares outstanding, next pillar, they went from 367 million shares outstanding to 355. Remember, we want to see this decreasing because this shows that they're thanking the owners by having less shares outstanding. The less shares that happen, the people that owned a share here in 2015 now own a few percentage points more than they did in 2019 because now they're splitting the revenue and profit amongst a lower number of shares. That's very important to understand. If this number was increasing, it's hurting you as an investor because now they're splitting the same number of dollars in revenue and profit amongst more investors now. So you want to see at least the same, but hopefully decreasing. All right, so now next pillar is total current assets greater than total current liabilities. Let's see this thing load up. We have total current assets of 3.8 billion and total current liabilities of 3.4 billion. So it is a check mark, not by much, but it is a check mark. They have a lot of liabilities though, 13.5 billion, which is up significantly from the previous years. As you can tell right here, they had decreasing liabilities for a while, and then all of a sudden skyrocketed in 2019. So one of the things you need to do is understand, why did they increase their debt so much from 2018 to 2019? Did they make an acquisition? Did they do it? There's a million reasons why it could happen. You need to find out why that is. The 8 pillars, again, is not for you to just sit there and go, oh, this is all figured out, we're done. That's not the reason. You have to go do more research to determine what the company is doing to go forward. Next pillar, and the most important ones are the last two, increasing free cash flow. Now remember, free cash flow, we want it to be, we want the free cash flow to be increasing. And free cash flow is operating cash, operating profit, less capital expenditures. You'll get that from the cash from operations and the net change in capital expenditures. Now remember, this net change in capital expenditures will be a negative number, so you probably want to add these two together. The good news is they lost money in the last 2 years, but they had free cash flow. Now, some people don't understand that. It is possible to have a loss, but have free cash flow. A loss could be caused by a write-off of a previous acquisition. That is a non-cash expense in day one. So in the day that it happened, the write-off occurred. So it's still possible to have free cash flow. So it'll be important when free cash flow and net income are so far apart to understand why that is. Over long periods of time, they should equate out. How long? 5, 10 years, they should equate out. But this is something important to understand. So in the last 5 years, we had 800 million, 850, 800, another 800, 500, 500. So 2.4, 3.4, call it 3. About $700 million a year in the last 5 years. So that is an X because it went from 800 million to 500 million. But more importantly now, the multiple. So we have an average of about $700 million a year in free cash flow, but it's decreasing. Usually multiply by 20 if the cash flow is increasing, and by a lower number if it's decreasing. If you're buying a decreasing cash flow entity, you need to make more money. You need to pay less money for that cash flow because over time it's going down. As an example, in the next 5 years, if you had $5, then 4, then 3, then 2, then 1, then 0, and your business is gone, that 5, 4, 3, 2, 1, I think that's $15 in free cash flow, is worth something to you. Is it worth over 15? Well, no, because why would you pay $15 to get 15 over the next 5 years? You're going to pay something lower than that. So that's the idea here. So for a company like this, I would sit there and say, just to be conservative, you want 10 times free cash flow. So if the average is 700 million, you want 10 times that. That's $7 billion. And I already forget what the company's market cap is. 6.8. Okay. This could be a possibility then. Now, remember, it is decreasing. The average is 700 million. Most recent years are 500 million. This could still be a buy if you buy into their future plans and what they're announcing today that caused the stock to go up so much. If they have a plan for a turnaround that's going to get them back to their glory years, then this might be a buy right now. But this company definitely requires more research. Most of these stocks that I do on the biggest gainer and biggest loser will require more research because for them to jump up and jump down so much, something has happened so in the short run. So you need to see how much that's going to affect the long run. So that's the biggest loser today. Let's go to a little more positive, I guess. The biggest gainer today, Qorvo Inc. Market cap of 18 billion. What do? They represent the combined entity of RF Micro Devices and TriQuint Semiconductor. The company specializes in radio frequency filters, power amplifiers, and front-end. I have no idea what that means. Wireless base stations, cable TV, networking equipment, and infrastructure and military applications. So they're up. Oh, wait a second. I'm sorry. In the previous example, Nielsen was down. Wait a second. Which one was up today? Oh, sorry. This is Qorvo. They're down a lot today. Sorry about that. They're down a lot today. So, analyst actions. Let's see here. Why are they down today? They must have been downgraded. Let's see, that's probably what it was. There's probably a downgrade today of some sort that got, initiates this Qorvo as a neutral. So who knows? It doesn't seem like there's some major news, just some upgrades and downgrades. So let's figure this out. $18 billion company. PE, 42. All right, that's a lot. We want to see it below 20 with some sort of growth in there to justify growing into the 20. So right now it's an X there. Profit margin though, 13% for the quarter. Looks like about 13% for the trailing 12 months. So seems pretty consistent. That's a check mark there. A nice, good quarterly gross profit margin, 46%. So far, 1X, 1 check. Let's go to the financial statements, see their revenue growth over the last 5 years. 2.6, 3.0, 2.97, 3.0, 3.2. So a check mark there. A couple of big jumps over the last few years you can see right here. 964 to 1.15 to 1.7 to 2.6 to 3. So there were some big jumps here, so you have to understand why that is. Next, we're going to go to the profit over the last 5 years. They went from losing 28 million 5 years ago to making 334 this past year. That's a big, big jump. That's awesome. Check mark there. Let's see how they're doing in the last 12 months. Trailing 12 months. And again, this will all be available on the Everything Money app at some point. 445 million. So in the last 12 months, they've actually made $445 million in profit. So it seems like this company's in the uptrend. So I wonder why they were downgraded. And let's go see their shares outstanding. They went from 141 million, $142 million. I don't know if you guys can see that because of my face. Let's go right here. 141 right here to 117. So they've decreased the number of shares outstanding by almost 20%. That's awesome. Not quite 20%, call it 15 to 16%. That's great. So a check mark there. So now current assets over current liabilities. Let's see how that looks right now. All right, quarterly current assets, $3 billion on the nose right here. Current liabilities. Let's see here. Total current liabilities, 1.47. This is really good. So they have plenty of money to handle their current liabilities and almost enough to pay off all their liabilities. So this company has enough cash on hand, almost about $400 million short from buying their entire current total liabilities, pay off all the debt. That means you have 100 grand in your bank account and all of your debts combined. Everything you can imagine, your mortgage, your car, your credit cards, all your utility bills, all your current bills on your desk would be about $120,000, $110,000. So you could almost pay off everything you want. It's harder to go bankrupt when you have a lot less debt. It's not impossible, but it's harder. So this is a check mark still, and it's a good one too. So now to go to the most important ones for me, free cash flow. Let's see, over the last 5 years. All right, so 305 plus, oh no, that's not that. 687, 688 plus 776 plus 852 plus 810 plus 945. So I basically added up all the operating cash flows. Now I'm going to subtract out all the capital expenditures. 315 minus 552 minus 270 minus 221 minus 164. Divided by 5, an average of $510 million per year. Now, first off, it is growing. We went from 370 million to 790 million or so. So it is growing, check mark there, and it's growing at a pretty good pace. So this one I think justifies the 20 times. You want to pay $10 billion for this company. Now, right now at 20 times, it is selling for 18 billion. I do agree with the analysts in the sense of downgrade. I think it's actually worth less. You want to pay 10 billion, it's at 18 billion right now. So it's got to drop by 45%, almost in half. So this is about a $90 company to me, according to my numbers. Now, again, this is a high-level view. There might be something you find in their 10K or their investor calls that has them going to some major contract and driving things up big time. But the good news is they were in this price range in the last year, back in March. You just got to be patient. That's the whole point of this investing. The 8 pillars are to provide you a high-level view. I'm not saying $90 is in stone, but it's something you can do your analysis of and see where you stand. The point of value investing is to get a huge margin of safety. This has no margin of safety because I'm sitting there saying, let's say it's worth 120 bucks. It's at 160. When a company you think is worth $120 a share, you want to be paying 70 or 80 for that margin of safety. So on this one, these are the 2 stocks right here. Nielsen had some potential. Got to find out what their plans are for the future. And then Qorvo, you have to look for their plans for the future, but as of right now, it just seems like it's too expensive. So thanks, guys. I'm going to try to do this every single day for big market recaps on the biggest gainers and losers. Thanks very much, and I'll talk to you guys soon.